Hi, welcome back. It's Neil again. And you're probably wondering, okay, what are we doing in this part here? In the last session, we started the theme of that accounting, in some ways, it's all about supporting value creation activities in the organization. And I showed you how accounting measures like return on investment, residual income, are going to be more micro and controllable and used as an accountability device than market-based summary measures. Of course, non-financial measures are better still because they really get to the operations of the organization, the inputs, the processes, whereas the accounting measures focus more on the outputs of transactions, the output of buying, purchasing expenses, the output of making a sale. You see what I mean here. Accounting is about value creation in the organization. Value creation is what matters the most. And so it is not the accounting that does the value creation, but the accounting is one of the legs of the three-legged stool. Summary accounting measures is one of the legs of the three-legged stool that can help to be used as an accountability device, as a incentive device, as a motivation device, as a way of attaching bonuses to various actions by managers. So think about, we've got value creation, then we have value creation activities, that is managers making investments, managers making decisions, managers providing services, managers making products, managers doing innovation, managers doing marketing. And then we have the accounting measures, which are kind of a summary of all of these activities. And so what we want to use, we want to try and use this system that's there, that is a way of driving the accountability of manager actions towards the valuation creation of the organization. And so because the system is already there, why not use it? Okay, why do we need to create a new system to make managers accountable? The accounting system is there. Is there some measure in the accounting system that we can use to make managers accountable? And that's what this is about, this session this week. And yes, there are. We could use market measures, but they're so far away from the actual day-to-day actions that managers may take. Why not use summary profit measures, or summary cost measures, or summary return on investment measures, or summary revenue measures? Why can't we use them? Yes, we can. The accounting system is measuring them from month to month, and so therefore we can get closer accountability of manager actions from month to month, quarter to quarter. And so if we can get closer accountability of manager actions, then we can attach bonuses to their achievements measured by the accounting numbers. That's what we're trying to do. That's all we're trying to do. Value creation, we've got these activities and we want to try and measure and control these activities with some kind of KPI accountability device, especially for divisional managers. Okay, they're in charge of investment center, cost center, profit center, or even revenue centers. All right, so that's what we're trying to do. That's what we're about. So let's get into the example of what residual income is about, what return on investment is about. And let me grab my beautiful pointer here. And so we have strategic business unit. We have A, B, C, D, and E. And I want you to take you across here. We've got cash, receivables, inventories, fixed assets, total investment, profit, return on investment. Now this is the percentage return on investment. So let's take this profit figure, okay, and let's pretend that this line keeps on going across. All right, it keeps on moving across, all right, it keeps on moving across to your right, okay. All right, which is kind of out that way, right? All right, so really that across measure movement is at the bottom here. All right, so therefore see the profits, 24, 14, 10, 3.8, there it is here, 24, 14.4, 10.5, 3.8. You can see that we're still working with SBU unit A, B, C, D, and E. You've got current assets, then required earnings based on some 4% of benchmark for, that's a charge, an interest charge on current assets. Then we have fixed assets, and now we have required earnings for fixed assets based on a 10% charge on fixed assets. And then we have residual income, which is the difference between the actual profit and the total required earnings. The total required earnings is the 2.4 plus the 6. So now that's 8.4. Take that off 24 and we get 15.6. So you can do the calculation now. All right, so we've got SB unit A, B, C, and D, E. They have the return on investment, 20%, 12, 10, 5, and 6. But they also have residual income of 15.6, 16.6, 5.7, 1.6, and 3.8. Now, based on return on investment, guess what? SB unit E is not going very, very well. But based on residual income, guess what? D is not going very well, and E is not going very well. You see that? So there is a different signal that is created by return on investment compared with residual income, because with residual income you're really focusing on cash flow. You're not focusing on a percentage. You're focusing on a benchmark that is created by a percentage here that creates a benchmark, and that's taken off the profit cash flow to give you the net residual income. So I want you to think about return on investment and residual income as two different approaches to measuring, benchmarking, and comparing the performance, value creation performance of different divisions in the organization. So let's go to the next stage so I can illustrate when return on investment may or may not work as efficiently, as effectively as residual income. Okay, return on investment provides different incentives for investments across business units. The SBU manager will not invest, if the corporate cost of capital is 10%. The business unit ROI is 20%. If the internal rate of return of a new project is greater than the corporate cost of capital, but it is less than its own business unit, then the SBU manager will not invest. You see that? So the big comparison here is that if currently the SBU manager, if they want 20%, that's what they got last term, that's what they got, that's what they're shooting for. And if a project comes across their desk, hey, Mr. Manager, would you like to invest in this project? And the manager will say, well, what is the internal rate of return? And they say, oh, it's about 17%. 17%? Hell no way. My current return on investment is 20%. If I accept this project 17%, that is less than my current business unit return on investment of 20%. My current return on investment is going to be lower than 20% in aggregate, and my bonus is going to be less. It's not going to be more. So right now I have to say no, I'm sorry. There you go. Now, from the point of view of the corporate cost of capital, that is the big head office, they look at this 17% project, and guess what? They're going to say, Mr. SBU manager, you should accept this project. Why? Because 17% is greater than this 10% corporate cost of capital. Wow. And because it's greater than the corporate cost of capital of 10%, if you invest, then the value of our organization, the value creation of our organization is going to increase. It's not going to decrease. So you can see there's a bit of a conflict of objectives here between what the business unit may decide to be an optimal investment and what is optimal for the corporate cost of capital, for the corporate, the head office, in terms of value creation. And we don't want to have these conflicts. And this conflict is brought about because we're using return on investment. The other way is the SBU manager, maybe currently they have a 5% return on investment. All right, let's put that in, 5%. He will invest if this 17% project, well, let's use a 7% project. All right, a 7% project. It's greater than 5%. Hey, Mr. Manager, would you like this project? Manager looks at, currently on 5%. This project here, 7%. Wow, if I accept this project, I'm going to get 7%. That's going to increase my overall aggregate return on investment above 5%. Hey, I'm going to get more bonus. Hell yes, I'm going to accept this project. Now, from the corporate point of view, the head office, they look at this project, 7%. Wow, our current value creation is at a 10% level. If we as a group accept this project, our value creation is going to go down. It's not going to go up. That's no good for our value creation strategy. So now we have another conflict where a divisional manager accepts a project when they should not have accepted the project. And this is what we mean by this is what we mean when we say that return on investment can create conflicts in terms of what should be a good investment at the corporate level and what is perceived to be a good investment at the divisional level. So, if the corporate cost of capital is 10%, remember, A and B have a current return on investment of 20% and 12%. So, if it is 11%, guess what? A and B are going to say no. But really, A and B, for the value creation for the corporate as a whole, they should say yes, but they say no. Alternatively, if the internal rate of return of a project is 9%, then D and E are still unlikely. Alternatively, if the internal rate of return of a project is 9%, then D and E are still likely to invest. What do we mean by that? Well, there's D and there's E. D is 5%, E is minus 6%. So 9% is greater than 5%, 9% is greater than minus 6%. They will invest, but that 9% return project is going to diminish the value of the organization as a whole, because the organization as a whole is currently working at a value creation of 10%. The corporate cost of capital is 10%. Anything lower than that, no one in the organization should invest. But here we have D and E saying, yes, we'll invest because for my division, that's value creation, even though it's not value creation for the head office as a whole. So this is what we mean by the conflicts that could be caused when we use return on investment.